Hey guys, so this is my video on how to invest in the stock market if you know absolutely nothing about the stock market. So, why are you interested? So you're probably interested for many reasons, but I think most likely you guys are interested due to the current stock market crash. Yeah, so let's get to it. Before I begin, disclaimer, I'm not an expert, nor I pretend to be. I'm wearing a lot of makeup, so I might look like it, but I'm not. I'm just a student with an interest in the stock market. I'm in psychology and computer science, nothing related to finance, personal interest only. I'm also looking at savings for retirement. I want to retire by the time I'm 35. I'm 22. Yeah. Might not happen, but that's just the goal. A prof laughed at me. Anyways, I also feel like there isn't really any female presence in the YouTube community just for financial information, so I'm like, I guess fill a void. I don't know. Yeah. So again, everything I say is just my opinion entirely, and at the end of the day, by no means take it as stern financial advice. I just really want to say that I'm not an expert. I'm a psychology student. So I also won't be going too into depth, just because I want to introduce you guys to the fundamentals of trading without scaring you guys all the way. Because personally, I find there's a lot of jargon and just like bullshit terms where I'm like, okay, I have no idea what they are saying. And a lot of men that are middle-aged, and it's just intimidating to be honest when someone doesn't look like you and you're like getting advice from them. I don't know, maybe that's just me. Anyways, prereqs for trading. So you have to have these things before you even consider trading, okay? So number one, you have to have at least $500 to $1,000 plus to invest, okay? Right off the bat. If you have anything less than $500, you can invest, but by the time like the fees of trading and such, it just wouldn't be worth it. Also, number two, huge one. Because of the global economy possibly crashing, it kind of already did, hence the stock market, the future is uncertain and there might be a global recession. So you have to have an emergency fund for that global recession, not including the money you're putting in the stock market. That money you're not going to touch for years possibly. So you want to make sure that you have an emergency fund. And that kind of goes with don't invest beyond your means. If you have $400 but you have a phone payment that's $200, don't invest that money. It's just not smart. You probably will end up losing money in the end because you'll have to pull it out early. Then when you're done, you got the prereqs, you're good, you're in. Then you're going to set up an online brokerage account. So you can pick whatever one you like. I personally like Questrade. I like Questrade just because of the $0 fees to buy an ETF. I'll go over later what that is. Really low fees for buying stocks compared to, I used TD for a while and they had $10 fees for buying stocks, where Questrade has one of the lowest in the industries, I think, currently in Canada at least, and it was only $5. Okay, disclaimer. This next part is heavily Canadian, okay? Only this little, 1 minute of the video. So if you're not Canadian, it might not apply to you exactly. So take it with a couple grains. The next thing you're gonna have to do is set up a TFSA, okay? So if you don't know what that is, or you haven't already reached your limit because you know what that is, a TFSA is a special type of savings account that's offered in Canada. It was created in 2009 to entice more Canadians to invest. So you can put an average of $5,000 about per year and contribute. You can put $5,000 per year in it since the age of 18. So I'm 22, so I'd be able to put $20,000 in it. I don't have that much in it, but I could. Okay. So the great thing about the TFSA, which I'm getting so excited about, it's insane how many people don't know about it that are it's our age. I don't know. It's wild. It's the inner Jew in me. I really don't know. But the great thing about it is in Canada, almost any other way, if you make an income, you will be taxed. If you're making an income from tutoring, unless you're doing it under the table, you will be taxed. If you're working a job, you'll be taxed on your earnings. Where in Canada, if you make money on your investments in your TFSA only, mind you, you're not going to be taxed. It's amazing. It's a tax-free savings account. So if you make $100,000, you take that home. Zero tax. Wild. Okay. So with Questrade, you can set up a TFSA on the trading site, but you will need a minimum of $1,000 to invest. If you do TD, you won't need that minimum, but just be wary of the fees for buying individual stocks. So that's why I would recommend about $1,000, to be honest, to invest. So after that, your account will process, you'll get confirmed, and then you're good to trade. The next step, you want to decide what you want to save for and how and when you'll need your money. Warning, if it's for 2 months from now, don't invest. The kind of sweet spot, you'll need at least 3 to 5 years, even 10, to see the full potential in your investments. Determine what type of investor you are. Would you like to be a passive or an active investor, and what's your risk level? So if you're a passive investor and you have a low risk level, I'd recommend an index fund or an ETF. I personally would pick an ETF. So an index fund, first of all, is something that tracks the whole market. So let's say the Toronto Stock Exchange or the New York Stock Exchange, or even, oh shit, I have a lot of notes, I'm sorry. Even the global economy. So you're buying into the whole market. If you look at trends of most developed countries, the index usually, unless there's a zombie apocalypse, like I don't even know when we all die, the index will go up and increase over time. For example, the Toronto Stock Exchange has an annual return of 5.72% per year. So if you just keep your money in an index that tracks the Toronto Stock Exchange, you will make $5 on every $100 you have in it each year. But now we reach ETFs, which are very similar to index funds, but I prefer them, and here's why. So an index fund is managed by a bank and has a high MER. So it's like a management fee that eats away at any profits you would make, and it's really sneaky because it's kind of hidden in the cost of the stock, and it just kind of, every time you get money, the banks take it away. So an ETF, they also have MERs, management fees, but they're significantly lower than index funds. So a regular cost, let's say for a MER, could be something like 0.08%, so less than a percent, where an average cost of an index fund can be up to 1.5% of the MER, so that evil fee where they take away your money. So ETFs are the way to go. So an ETF, it's like a basket, so you're still passive, but an ETF will hold multiple stocks at once. So if you're not sure what individual stock to invest in, sorry, I'm looking at the page again, then invest in an ETF because you'll be holding multiple of them at once. One of my favorite ETFs is the S&P 500. So that is an ETF that tracks 500 of the best performing American companies like Apple and Microsoft. The annual return, my Jamaican boyfriend is in bed if you hear any grumpy Jamaican man sounds, I'm sorry. So the annual return is about, for the S&P 500, so how much you make every year, is about 10%. So that's much higher than any savings account you're going to get in Canada, or I'm not sure where you are, but most likely anywhere you are. Okay, and third, let's talk about individual stocks. So this would be considered the most active part of investing and definitely the most risky, but high risk can also mean a potential for higher rewards. So as a beginner, how do you know what stocks are good? So what I do primarily, just as a noob, and what I would recommend for a beginner, is look for blue chip companies. So that's just kind of a fancy word for a corporation with a national reputation for quality, reliability, and ability to operate profitably, I can't speak, in good and bad times. I stole this from Google. Yeah, so in other words, it's the companies like Apple, Microsoft, 3M. They've been around for so long and they're sturdy, and yeah, I don't. Also, other sources for Canadians, if you're looking for individual stocks, Canadian Investor, that's a great subreddit on Reddit. And of course, YouTube, love YouTube, but take everything you watch kind of with a grain of salt. Sometimes you don't know the agendas of people speaking on YouTube. Even with me, like, just take everything I say with a grain of salt. Also, if you're feeling lazy and you want to invest in some individual stocks, literally look at the top performing companies in the S&P 500 and then just pick your favorite. I picked Disney. I just like the movie Frozen. So at this point, the market's doing so badly that in any blue chip company you invest in, you're probably going to make a profit just because of how poorly the stock market's doing. So there are other metrics that you could look at, but because you're a beginner, I'm not really going to elaborate on them. You don't really need them for blue chip companies just because they are so stable. So that would be like price to earnings and debt load. So I won't go into them there, but I can go into them in another video if you're interested. Yeah. So you can also trade in USD if you're Canadian or any other currency. Just be aware of the exchange rates when they change, and if you take your money out while it's maybe a poor exchange rate, you would lose some money on that. So now, boom, this is the exciting part. Let's talk about dividends, baby. Oh yeah. Okay, so all of those stocks that we mentioned before, so ETFs, individual stocks, I don't know about index funds, I'm going to be honest, but ETFs and individual stocks have the potential for dividends. So a dividend essentially is when a company has excess cash flow, they can say, okay, so just by owning the stock, you're going to get a certain amount of money guaranteed every year. And that price usually goes up. So if a stock has a 6% dividend yield, you're going to make $6 on that stock. It also has something to do with the ratio. So if a company gives you, let's say, 0.25 cents on $20, you're going to get a bigger dividend yield than if that stock price goes up and it's still only 25 cents on $40. So if you buy a stock that goes down in price and the dividend is the same, 25 cents, you're going to get a bigger yield and you're locking that in by buying it, essentially. Sorry if that's confusing or not the easiest to pick up. It did take me a little bit. But beware, if a dividend sounds too good to be true, like 20%, it probably is. It might mean a company's not doing well financially, or it's on the brink of bankruptcy, or it's just not a blue chip company or something you really want to invest your money in. Also note, a company can cut their dividends at any time, like during a recession, but if it has a history of increasing its dividends, like a company like 3M, which I'm personally invested in, they've been giving their dividends even throughout the 2008 recession. Consistently, they've been going up for 50 years. So a company like that, I wouldn't really be worried. And even if a company did get rid of their dividends, they can always bring it back once they have more cash flow. And then you still locked in that dividend price once it comes back. So that's something to note. So then last page, sorry, I'm trying to keep up. Last risk factors, will this company go bankrupt? So if they're giving dividends consistently, they usually have a cash flow and they probably won't be go bankrupt. Also, one last note, don't try to time the market, rather inch your way in. So maybe $200 this week, $2 next week, and so on. Even Warren Buffett says it. There's no real way to time the market. And if you do, like, you know, the market's low right now. And if you really like a stock and you look at the history and the charts and maybe you look into some more of the detailed metrics because you're just better than me, then go for it and do it in increments. Just trying to time the market is a fool's game. Just because this video is so long, I'm not going to go into my personal investments, but if you guys are interested, I could put that in another video. Like, comment, subscribe. Hopefully this wasn't too bad of a video. Add me on LinkedIn. I don't know. All right. Thanks, guys. Bye.